Hello folks, I'm L.A. Little and this is your daily NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective. Each time we ask ourselves what happened today and what does it tell us about the coming ones. I do this show 4 times a week, Monday through Thursday. It's broadcast at or before 10 o'clock Eastern Time, archived on YouTube. It's under the channel L.A. Little. You can subscribe to it there. Get updates whenever videos come out. Sorry about last night. I had some unforeseen circumstances, unable to do the show. Back on schedule tonight. Appreciate you bearing with me, given the fact that I had to leave and couldn't do the show. I try to be prompt and on time, and always give you some good material. But sometimes things are outside your control. Let's look at these markets today, what happened, and actually kind of review last night too as well. Markets up today. The bad thing here is that they were up a lot more. They lost almost 1%. They lost about 2/3 of what they had. Gold, silver, so forth down. Bonds up again. Dollar was up. It was another rout in the oil market today. 2.5% again. Oil's under $60 now, and I don't know where the bottom is, and nobody knows where the bottom is. And although I'm sure it doesn't explain everything, it certainly explains a lot of what we're seeing in these markets, and we'll talk about that here a little bit more in the spotlight tonight. Let's pop over to the charts. Now, yesterday we actually had, let's go back to the beginning of the week. So on Monday, right, we come off the highs. Okay, that makes sense. And then we were talking about Monday that we could see a range trade breakdown, and that it would carry, about equidistance to the backside. And if we draw in what that looks like, it did just about that. Comes down, goes back up, ends up in the top half. And if I look at yesterday when I was unable to do the show, we actually came off that hammer reversal, traded down with more volume, and closed under it. So that's a reversal of that hammer. That's not a good sign. So it's basically a takeaway bar. So we took away all the goodness of that hammer right back down. Well, today we did a takeaway of the takeaway. So in other words, we go all the way back up, basically taking away all the badness from yesterday. But by the end of the day, we're back down there, and we only hold on to about 1/3 of the gains. That tells me that what we already had, which was the takeaway bar, still is in effect. Now the only and the reason for that is because these were inside bars today. In other words, they didn't add additional information. Now if you think about what happened today, to some extent you did get some more information, and that is that you pushed up but you couldn't hold it, and that's negative. But the fact that it was an inside bar makes me look back at the day before, which was a takeaway of the prior. That suggests to me that we're going to try to test lower again. Now, if you look at this on a weekly basis, and I'm going to pop over here to this chart, the retest regen is here. That high is 2019 and a quarter. We got to about 2025, I think, 2024. So we're not that far away, in terms of this swing point high being tested. And so that's kind of where we're at here. And so the question is this thing going to come back in here and do some testing? Note that it's coming back within 6 bars. This is number 5. So the fact that we're coming back makes the probabilities a little bit lower, but they're still good. There's something around 68%. So we should see this retest and attempt to regen. Now, the other piece of that is, because it's coming back so fast, is it could get to the lower end of this. It doesn't have to test just the top. It could test anywhere in between. You take the low is 1978. Top is 2019. That's a pretty big difference. We're talking 41 points. So we could get a 41 point drop and still be in a nice bullish scenario. So that's, I guess, a decent wrap of what is reasonably applicable to all the indexes. If I look at the Dow Jones, it's the same thing, right? You do a takeaway. Now you try to take that back away, don't have it, inside day. You had an inside day on the NASDAQ. Same sort of thing, gave it up. Looks worse. NDX also looks worse. So these gave it up harder. And the Russell gave it up, but not quite as bad in terms of the percentage, but the same sort of bar. So you go up, you can't hold it, you flip back around, you go back the other way. What's causing all this? Well, if I look over at the oil market, it's not too hard to see that this thing can't find a bottom. Folks, this thing is down 40% already. That's a huge drop in a very important sector. You know, the energy sector, oil drillers, you know, there is a big piece. A lot of the investment that's been taking place has been in this sector, which is going to lead to part of what we're talking about here in the spotlight tonight, and that is that we're seeing junk bonds, right, plummet. And we'll get to this in a minute, but if I pop over here, you know, these guys can't find a bottom either. So let's come back to those in a bit, but that really is, in a nutshell, what's happening to the equities, and that is that they're hostage. I don't believe they're hostage to the bonds as much as they're hostage to oil and oil's inability to find a bottom. I say that as I did the other day, in that when we look at the oil market and you think about, you know, the plunging equities inside of it, and I can go to any of these, you know, if I go to OIH, which is the drillers, right, you can see how they reversed today. If I go to the XLE, same sort of thing, reverses. They can't hold price. They keep trying to hold price. They tried to hold it here, right? You do an under over, that's not a bad start. You go back in to do a retest regen, boom, back the other way, right? You lose it all because oil plummets again. Tries to go back up today. What does it do? It gives it all up. And today was actually in particular nasty on the XLE. That top was, I mean, the bottom was 77.51. You got to 77.34, so you didn't quite get back into it. But you got over yesterday and back under, well, not back under, you got over and under and less volume. That's negative, right? It says it's going to try to trade lower again. Without oil finding a bottom, this market's going to struggle. You know, I think I've said it here on the program. I know I've said it to members. You know, until we find a bottom in the oil market. And the reason for that is you have a lot of uncertainty that this is creating. And I suspect there's a decent amount of bleed over into corporate debt, in particular junk debt, that's being affected by this. Not only is it affecting energy-specific debt, it's affecting all the debt. Because why? Well, because nobody knows what's going to happen, right? I mean, you know, there's more and more uncertainty, and uncertainty breeds fear. Fear drops the prices. So I believe that's what really is taking place out here. If I look at the sectors, you know, some of these are holding up, some aren't. So these biotechs still hanging at the highs. If I look at the stocks did a reversal, inside bar, more volume. If I look at the XLF, you know, the XLF goes up, stays inside the bar, same sort of scenario we see on the indexes. XLK was interesting. It actually got over the high from yesterday and back under it, so it wasn't an inside bar and had more volume. That suggests it's going to try to go do it again. So there's just a confluence of factors. Well, here's another one. Here's the XLP. It's the same sort of thing. Goes over, back under, has less volume, slightly less. So you've got a lot of mixed signals into sectors, which brings me back to the indexes. I don't see anything in the world markets different. Europe is trying to retest regen higher. Looks like they're going to do that, although it's a struggle right now. That's all central bank. China looks like it's going to try to trade higher. Again, money comes pumping in from the Chinese authorities today. So, you know, the central bank centric markets, they're still holding up. Everything else struggling. Here, it's a struggle because of oil. Okay, let's pop into the OX markets because I want to take a quick look at another way of looking at this, which is the EEM. Right, the emerging markets selling down. This is an ABCD structure. It looks like it just about completed already. So you have an A point, B point, right? That looks like it's actually more than completed. Breaks under this, so the bounce when it comes, you know, assuming it bounces, it's going to have a retest, actually a retest regen up into this area. So EEM, underscoring the emerging markets and the difficulty they're having. It's also a break over here. If it holds on the weekly, that could see, you know, a little bounce and more extension. So I'm not particularly positive about the world markets with the energy dropping like it is. It's affecting everything. With the dollar moving higher, it's affecting everything. If I look at gold, although the dollar's kind of stagnant here, it's not like skyrocketing. It's just kind of holding. Gold is holding up here, doesn't want to give it up. It's over this, right? That made this into a range trade, but until it gets over this high, it doesn't matter, in my opinion. In other words, it's still just a range trade because that's the swing point high on the weekly up there, and it has to get over that to really change the trend. If I look at silver, it's about the same. I do want to point out bonds while I'm here. They're going back up, doing an ABCD structure completed today. So here's another sign that equities should try to hold, but right now, you know, equities are struggling as long as oil does, and I suspect unless oil finds a bottom, that's going to continue to be true. If I pop over to the gasoline market, you can see the plunge in prices here. Going back one more time to the USO, you can see the plunge here. If you look at it on the weekly, or if you pull over to the monthly, it's all the same. It's just down, down, down. And there was a quote today out of the Saudi minister saying, "Why should we cut production? Why?" Well, I guess that kind of explains it all, huh? That's why oil's going down so much. Nobody wants to do anything about it, and it's going to try to seek equilibrium. Here's the dollar chart. So the dollar has kind of stair-stepped up in kind of these range fashions that we've talked about before, right? You can see how that's about the same range. Gets to the top, what does it do? It starts consolidating. Inside that, you actually have another one, right? It's like that. You can see how those are about equidistant. So right now, it looks like this is just a big range trade in this area. It's probably going to continue for a while, and then at some point, probably move on higher again. All right, so synopsis. What do I think? Well, I think we're hostage to oil. I don't think there's anything more than that going on here. And as long as oil can't find a bottom, then I don't think these markets are going to find a bottom. And you know, it doesn't mean they're going to plunge, but the way it looks to me tonight, you know, when I look at these charts, it does look like this market's going to try to trade lower tomorrow. And that's because of the give up today. You know, you go back up, you can't hold it. The ideal situation today would have actually been to start down, not to gap up. In other words, the buyers just can't wait to jump on this market. Well, they did it. They did it on the reversal. Let me pull up the chart again here. If we look back on Tuesday, they jumped all over, they traded down and jumped all over it and took it back up, right? Then you get the plunge. What would have been the best case today is actually to trade lower, right? Get back into the swing point high here and on the weekly, and then have the buyers come in, right? I mean, that would have been an ideal case. You don't want to gap up because anybody that buys a gap up now is more exposed. You want to buy a gap down. Well, tomorrow they're probably going to get a gap down, the way this thing is probably set up here tonight. And they're going to test that low. If that low breaks, then everybody's going to be fearful. And I haven't looked at all. Let me pull up the futures right quick to see what it all looks like. My guess is, because I saw it was trading down right after the close. Yeah, heck, it's down another buck, 1%. It's at 59 now. So that seems to suggest that we're going to see more than likely, continued pressure on these markets come tomorrow. All right, let's go over to the viewer question, because it kind of feeds into all this, and that is there's a question here about junk bond, and actually this particular viewer had asked me this question before, and I think it was a couple of weeks ago, and we talked about the relationship between junk bonds and TLT. So what I did is I pulled up a chart again of that relationship, and I put the junk bonds here in blue. And then there's two more. The green is the S&P. This kind of amber is the LQD, which is the high quality corporate debt. And this is the junk bonds. Now, the reason I put oil on here is because I really believe oil is driving so much of this activity right now. And you can see as oil began to plunge, and I'm just going to kind of highlight, you can see as oil began to really plunge. I mean, it was going down here, but it really wasn't plunging until it got to this area. And so here we did a pretty good plunge. And off that area, you can see the move down in junk bonds, right? Not, percentage-wise, it's not going to be the same, but you can see that they're doing the same sort of thing. And you can also see the market at that time moved down. And I think the last time we talked about this, I was talking about these were moving at about the same time. There wasn't much lead or lag in between these. Corporate bonds, they actually went the other way. So, who knows? Those guys are kind of trading by themselves, and I'm going to show you another chart here in a minute that's going to show a little bit of a difference in what's happening to them. But for the most part, corporate bonds are just kind of hanging. They move up a little bit as the market strengthens, because they're high quality. So if the market's strong, they're typically going to be doing pretty well. So when the market gets fearful, that's when these things start to sell off. Now, as oil started to stabilize here, right? We had this junk bond plunge that took us down, twice here on this big move. As this stabilized, you saw this one pop back up. And then it kind of went sideways, although this drifted down, but not at the same pace, right? And then once it started to plunge again, you can see this starts to move down again. So just as I talked about the last time we looked at these relationships, right now it certainly looks to me like oil is driving the fear that's in the junk bonds. Now, that's not to discount the fear as much as to say I believe it's tied to this particular commodity, how fast that commodity is dropping, and the fear that it's causing. And not fear just with energy-related debt, although I'm sure a lot of that is what's really under pressure. But that debt, right, it bleeds over. And you get all the debt start, it starts migrating to all the debt. And so if oil were to stabilize and trade sideways for 6 months, I think this whole movement that you see in the junk bonds would just stabilize, and they'd probably work their way higher again. Because why? Well, because the equity markets would do the same. And that takes some of the fear out of these. So I believe that's a reasonable explanation about what's happening, how it's happening. I pulled up the spreads as well here on the various debt instruments, government debt instruments. Now you're not going to see much movement here at the short end of the curve. So this is like 1 to 3 years, 3 to 5, 7 to 10, and then 20. The 20-year, the 10-year, blah, 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 right? What you're really seeing on a percentage basis is you're seeing a huge move on the long end of the curve as people push money into that part of the market. On the short end of the curve, you're not seeing so much of it. And so what's happening is the spreads are widening on this debt. Now, typically when the spreads contract, although we're no longer typical at all anymore with all the central bank intervention, but typically when the spreads contract, right, as a matter of fact, there was a Fed paper about this, 15 years ago, that once you get the inverse curves, it goes negative. That's usually a precursor to a recession. When they start to widen, that's usually a precursor to more growth. And they've been widening. So I think that's a reflection of what's happening with the economy, and our economy being as strong as it is, and it's a place for people to put their money. So that's one more piece of it. And then finally, I want to pop over to here again and bring up the credit spreads. Now this is investment grade credit spreads. So this is like the McDonald's and Boeing and those types of companies. And the spread here is actually starting to widen again. Now if you look back, far enough back to 2007, 2008, this widening of the spread preceded the top in the equity markets. So in other words, when this spread widens, if it continues to widen and reaches a level that's 1.3, 1.4, typically after it's been doing, with the direction, let me try to say it a different way. It's been going down. Right? As it goes down, right, eventually it finds some sort of a bottom and heads back the other way, and that's what it's doing now. That was also true of what happened from about 2003 to 2007, right? The spread kept going down back in that period, and then it leveled out, and then eventually started to rise again. And that rise that took place was around the 2007 top. As that rise started to take place. Now, is this the same sort of thing? I don't know. I don't know if it is or isn't. But it is, the spread is widening, and it's something to watch. If it just continues to widen, the bonds are signaling fear. And fear usually is not a good thing for the markets. So I would be watching these bond instruments. I don't think it's the point I made last time, and I'll make again tonight, and that is that the timing here, these are not timing instruments. They're trends. And if the trends continue long enough, what will happen is we will see that effect over in these markets, in these equity markets. And that will, that can be kind of an early warning signal, canary in the coal mine kind of thing, that something larger is happening. But like anything in the markets, right? It doesn't necessarily, it's not a necessary and sufficient condition. In other words, we could get those widening spreads and then they narrow again. There's nothing to say they have to keep going. So I would prefer, as always, is to continue to watch each of the markets and weigh them as a whole and say, okay, what are the equities doing? What's gold doing? What's the bonds doing? What's high corporate debt doing? What's the municipals? So forth and so on. World markets, and use that whole bag of information and the transitions that take place, to try to put a valid picture together on whether or not we should have as much risk as we've had in equities or not. Because what you're trying to do all the time, and I'll wrap it up with this, is you're always trying to decide, okay, do I want as much risk here as I wanted here or as I wanted there, right? Where do I want most of my risk on the table? Usually you don't want all your risk or the majority of your risk on when you're up here at the highs. You really want most of your risk on somewhere down here. The problem is how do you know down here is where you want it, right? What you really want to see is you want to see something that gives you clues that this, what we see here now, is going to lead us back down to here. And if we're going to come back down to here, we do want to sell some up here somewhere. But we need some clear clues that tell us that's the most probable outcome. We don't have that yet. We may get it, but we don't have that yet. And when we do get it, it will be necessary for us to act on that. Folks, thanks for joining me. I appreciate it. I'll be off tomorrow and back with you on Sunday. I hope you had a good week so far and a good week coming, the weekend coming. Have yourself a great one. Thanks for listening. Take care, and I'll see you next time. Good night.